Hey everyone, this is Tracie Schmidt with the Schmidt team at Supreme Lending, and I am here with the amazing Patti Gregory. How are
Good
you?
morning. So happy to be here.
So Patti is a real estate agent. You're in Laguna Beach, but what areas do you
I
work?
lead a team. We work all over San Bernardino, Duarte. We've sold at the river, California side of the river, and of course, beautiful Laguna, but everywhere in between.
Awesome. So we're gonna just really quick talk about a new
Hot topic.
mortgage program. So it's called the 2-1 interest rate buydown. So if you're a buyer or a seller, you have to watch this. We're going to do some math. We're going to show you as a buyer how you could potentially get a lower interest rate, save money in your payments. And then as a seller, we were just talking about this, get your property moved quickly, get buyers in the door because things are changing a little bit in the market. So
Completely shifting.
are you
It's
ready?
Yes, I'm ready. Let's do it.
All right. So I did some math here for you as well. So let's go here. I got to share the right screen. Where are you? Here we go. Okay, perfect. So this program is called a 2-1 temporary interest rate buydown. And the reason why they say it's temporary is because it's 2 years that you get a lower interest rate. Now, not all mortgage lenders offer this program because the key is that you have to hold on to the servicing of the loan, right? Because what's happening is you're creating a separate account for the buyer.
Like another escrow account.
Exactly. So then dispersing that monthly to offset what the payment should be at the higher interest rate. So we're going to go through in this video information about the program. We're going to do some numbers so you can see a live example. We're going to go through ineligible transactions. And then we're also going to go through how this, kind of this versus just paying points, right?
Awesome.
And
Awesome.
just see the
Because
difference.
that's the other option, but it's not as good.
Exactly. The cool thing though is you can combine the two. So that's just another win-win depending on the situation. So can you see the wording okay?
Yes.
Okay. So, and stop me if you have questions as I'm going through this.
I will, for sure.
I tend to talk quickly, but okay. So 2-1 interest rate buydown is the name of the program. What I did is I assumed a sales price of $1,078,000 in Orange County. Okay. Like that's just the sales price that I used. And I took 10% down of that sales price, assuming that buyer would put that down. Now, again, you could put 5% down, right? Just depends on the loan limit per county. So that's why I did 10%, which is 107,866. So that gives us our loan amount of 970,114. Okay, 970,000. This is what we calculate the principal and interest payment on. So I want to let people know, because they may not know this, is when you're over a 647,200 loan amount, it becomes what's called a high balance loan. And Fannie Mae has loan level price adjustments that get added to the interest rate, the cost of the rate, when that happens. So in this example, because the loan amount is over that, you're going to see a higher interest rate than if the loan amount was under 647. Okay. But because your market's a little bit higher end in the price points.
Good sidebar.
Yeah. I wanted to let people know
just prepares people.
Absolutely.
Yeah. That's our goal, is to make it, to educate everybody.
Absolutely. So if you're a buyer and you're purchasing a home owner occupied, meaning you're going to live in it within 60 days of closing, with a 10% down payment, the seller can contribute up to 6% of the sales price. Okay. So the math would be you take the sales price times 6%. This is the maximum that the seller would be able to contribute to the transaction of the buyer. Now, you don't have to contribute 64,000. You don't have to have that total amount, but I'm going to show you the minimum that you'd have to have in order.
And will you show us what happens if, say, they did half of that?
Mm-hmm.
Okay.
Well, I'll show you the total amount you need for this program. And then the difference, I'll show you like with a 1% or 2% buy down in rate.
Got it.
Okay. So we're going to assume an interest rate. I pulled this as of this morning. So I used a 780 credit score. 780 credit score, 45% debt to income ratio, 10% down payment. We're at about 6.5% with no buy down, meaning there's no points to buy down that rate.
Wow.
Okay. So I know. So when you're below the 647.2, you're more at like 5.875.
Okay. That's good.
Okay. So that's why I'm being like honest, because in your market, if someone wants to put 10% down, they're going to be over that loan.
They're definitely over. Yes.
You have to expect a higher rate. Okay. So we're going to always calculate in this program the principal and interest payment to use the example of how much of a credit you would need from the seller. So if you took our loan amount at that interest rate, the principal and interest payment would be $61.32. Okay, so that doesn't include taxes, it doesn't include insurance or private
just
mortgage
principal and
insurance,
interest.
just principal and interest. So what happens is year one of this program, the interest rate actually drops by 2% of what we locked you in at current market. Okay, Patty, so you're my buyer, you're in contract. I lock you in today at 6.5%. Your first year, your rate would drop to 4.5%. So 2% lower, okay? The principal and interest payment would actually drop to $49.15, which is about $1,200 lower a month.
That's significant.
It's crazy, right? Now think about it. When rates were 4.5%, right? You wish that people would buy, but it just whatever. You can't go backwards. Okay, so we're only going forwards. So you have to take the difference in payment of $1,200 and you multiply it by 12 months because the buyer is going to have that payment lower for the first year, which is about $14,600 in payment savings for that buyer. Okay, so we'll just keep that number kind of like shelved. Year two, what happens is the interest rate goes from the 6.5% and it goes down 1%. So it would go to 5.5%. Okay, the second year. The principal and interest would be $55.08, which is lowering it by $624 a month in year two. So that would save the buyer $74.88 in payment.
Look at that total savings, $22,000.
Exactly. So that's how we calculate what you would need from the seller, right? So we would take the first year savings, the second year savings, and add it together. So if we have $22,000 of a credit, which is only 2%, right? And we can go up to how much? Do you remember?
6.
Okay. So we're only using 2% of that 6, right? So they basically will take that 2% or that dollar amount and put it into a separate account and then pull from that account each month to offset the payment of the buyer. That's how it works. Okay. Now, a caveat to that is it cannot be the buyer's own funds. It has to come from the seller.
Has to be a seller credit.
Yeah. So seller credit, seller concession, seller contribution. I mean, there's so many different words for the same thing, right? But it's basically, and this is what we talk about with sellers, and you may have dealt with this where, you know, you have a house now that the market shifted. It's sitting on the market a little bit longer than it was before. And the conversation you have with a seller, Patty, in that instance is typically what? I mean, what generally were people doing if their house was sitting?
Price reduction. It's the only thing we could do.
Right.
And I have one right now. One listed 2 on July 8th. One's in escrow. The other one, we don't even have any calls. It's crazy. Right. We're in the weirdest market ever. And I got in the crash.
So that's why we're saying sellers, you know, the price reduction, it was usually the option. Now, instead of doing that, you have the option of giving a seller credit. Better. Right. So for example, if you were going to reduce your sales price by $22,000, instead you could give a credit for $22,000, you're going to net the same amount of money as a seller. But you're going to have more of an opportunity to sell your home because you have a program for a buyer that could lower their interest rate.
And then they're the good guy too.
Exactly.
Yeah.
Exactly. So now I wanted to just kind of compare. So for example, let's say the 2-1 buy down, just the buyer doesn't want to take the chance because in year 3, after the first 2 years, it goes back to that higher rate. Okay. It goes back to the 6.5 over the life.
6.5. Right.
Now, ideally, what would the goal be? That rates drop.
Hopefully they'll have equity and they can refi.
Exactly. Because you're putting 10% down.
Right.
You're having mortgage insurance. So the goal would be there's no prepayment penalty on the loans. You refinance, whether rates drop in year 1 or year 2. Let's say you refinance after year 2, you have enough equity to drop the mortgage insurance, right? If you have 20% equity, and then potentially refinance into a lower rate than the 6.5%.
Right. That's the plan.
That's the ultimate play for buyers. Now we can't guarantee that would happen, obviously, but that's kind of the idea of what would happen down the road. So before this, we were suggesting to buyers that they would use the seller credit to buy down the interest rate with discount points.
Right.
Okay? And we talked about this, right? So 1 point is 1% of the loan amount. And generally it changes the rate about a quarter, right? To 0.3% lower if you pay a point. So what I wanted to show is if the buyer used the 2% seller concession, right? Which means that they could buy down the rate by 2 points. instead of their rate being 6.5%, their rate would go down to 5.625. Okay. If they didn't do the 2-1 buy down and they just took the 2% seller
And
credit.
these are buyer funds, not seller funds.
No, I'm saying same situation.
Same seller credit.
Seller gives a credit of 2%. They use that credit to buy down the interest rate over the whole life of the loan, right? Versus just doing the 2-1 buy down for 2 years. It would drop the buyer's interest rate to 5.625 year 1, 2, 3, 4, all the way for the 30 years fixed, right? The principal and interest payment would be 55.85 in that scenario. Okay. Now remember, at 6.5%, it was 61.32, right? So if they don't do the 2-1 buy down and they use the 2% credit from the seller to pay 2 points and buy down the rate, their payment would be $547 a month lower over the life of the loan. Okay. But if I take 547 over 2 years, it's a savings of $13,128
versus 22K.
Exactly. Right. So it doesn't mean that you can't, you can choose whatever you want to do ultimately. Right. But if you don't want to take the risk of refinancing and after year 2, if you're not comfortable with the payment at 6.5 in year 3, then ideally we would talk about buying down the rate instead over the life of the loan. So again, there's options. And that's the point we're trying to get across to buyers and to sellers to figure out a way to get into a house and to sell your house quicker.
And attract more buyers. We always want a bigger buyer pool for our sellers.
Yeah. And then we just talked about that example, right? So like you could do total of 6% concession, right? So let's say we did 2% for the 2-1 buy down, and then we did 2% to buy down the rate. We're at 4%. Okay. So guess what would happen? This 5.625%, if we did both combined.
Question.
Yes.
So does the buy down of the rate happen first, then the 2 years? So does it
happens at the same time? So what would happen is I would lock in their rate at 5.625 with a 2-point cost paid by the seller. And then we'd also do the 2-1 buy down. So first year, their rate would be what, 3.625.
Oh, so it is, that one is first and then the 2-1. Okay, yes. Got it. Oh, that's phenomenal.
If then you get enough of a credit to be able to do both. Yeah, because you can combine it. Right. So, and then the second year would be 4.625. So ideally, if you have the ability to really negotiate a credit from the seller, or the seller's willing to do that instead of dropping their price 50 grand.
And right now with that, we're at 4% total.
You could still go another 2% to go towards closing costs.
Okay. Oh my gosh. Yes.
So because the 6%, right, in this scenario we talked about is all the way, like, what was that total amount that you can get? 64 grand.
Yeah.
Right. So, okay, at $1,078,000 was your list price, right? You drop it by, you don't drop your price by 60 grand. Instead, you give a 60 grand credit. You're netting the same amount of
all
money,
these benefits.
and then you get buyers more opportunity.
Awesome.
Exactly. So it's important to know each program has a different percentage that the seller can contribute. So if you did an owner occupied purchase and you only did 5% down as a buyer, the seller can only credit a maximum of 3%. Okay. So and if you're putting less money down, it means your payments are higher. So we would have to do a brand new calculation of what your payment difference would be over year 1 and year 2 with 5% down. Okay. An owner occupied purchase, this is conventional. 10% down, you can get 6%. FHA, the max is always 6%. And then VA, the max is always 4%.
Okay.
So we can do this product on conventional, FHA,
every loan.
VA
loans.
Exactly. So we'll just talk about really quick what's ineligible, because this was a question that I got asked. So you can't do it on
the non-conforming. Okay.
Yeah, you can't do it on ARMs or adjustable rate mortgages. No renovation programs. Non-conforming loans in our world is called jumbo.
Right.
Okay. No USDA. No
what's the jumbo number right now?
Yeah, and it has to be owner occ. You cannot be an investor or use it on an investment property.
Okay. What's the jumbo loan number right now?
So your county loan limit is what I used up here.
Oh, the 647.
Nope. Your county loan limit is like, I think it's like 980. Let me just look it up really quick.
Yeah, that sounds right.
They vary. Let me see. Orange County loan limit. This is what I do. I just Google it because I can't memorize everything.
Oh, it constantly changes.
Yeah. And so it is 970,800. And that's why
Okay.
I used this example of 10%
perfect.
down, because
Was
it
right
got
under.
us to that limit. So $1 over that 970, 800 would become jumbo financing, which we cannot use
Okay.
this program for. So,
This
and
is
then
great.
both the borrower and the seller are going to sign the buy down agreement at closing. So it just like protects everybody, you know, to know that that's what they're doing with that money.
Oh, this is awesome, because like I said, I have a condo that we're not getting any love on.
Yeah.
And this is something that the seller can do to attract more buyers.
Yeah. So what I would do in that scenario is send to you, you know, what it looks like, how much the seller would need to reduce the price, not reduce the price, but give a concession for, and then what that would look like for the buyer. And I'll usually do a spreadsheet and I'll show them, hey, this is the payment at current market. Because you have to qualify at the current market rate, right? You're not qualifying year one or year two. And then I'll show another tab, like this is what the rate would drop to and what your payments would be. And then,
perfect.
You know, yeah. So this way they really understand what that looks like. And again, hopefully have the goal of refinancing if they're able to do that.
Very good. This was great, Tracie. Thank
Yeah,
you.
you're very
Good
welcome.
way to start the week.
So
making buyers happy for a change. They haven't been happy in 2.5 years.
You know what? It's a win for the buyers and for the sellers, though, to be honest. I mean, and that's why working with someone like Patti and her team, I mean, knowing that these things are available and not just taking a price reduction, right? Because something's sitting, but figuring out ways to still get a maximum amount of money as a seller, but bring a really qualified potential buyer to close on that deal.
And more buyers.
More buyers. Yeah. The more buyers, the better.
Awesome. That's right. All right.
The days of a house sitting for one day, right?
It's long gone.
Yeah. So you're seeing some price reductions in your market, Patti, and some more inventory?
Mostly ones that were overpriced that should have gone on the market. You know, we can't say I told you so, but that's what we're in right now. They should have listed 4 months ago.
Right.
And so the price reductions are coming down. Like I said, the one in Corona at the Del Webb, also Del Mar, sold in less than 2 weeks, which is really good right now.
Right.
But the other one is just sitting. So it's a very unpredictable market.
Right. Well, let's try to get this product there for your seller and get some buyers in the door.
Awesome. Well, thank you so much.
Yeah, such a pleasure as always. And how would someone watch this, like reach out to you? What's the best way?
Oh, I am everywhere. Just Google me, Patti Gregory Realtor.
And it's Patti. So make sure you're spelling it correctly.
Awesome.
And same for me. Again, my name is Tracie Schmidt, and I'm physically in San Diego, California, but our team is licensed throughout California. And our region is licensed in 38 states throughout the country.
Tracie's also helping a client in my team in Georgia.
Yes. So
we're all over
the place. So same thing, Google, but I'm with an IE. So Patti and I spell our names differently. So make sure you're Googling the right person. So
awesome.
Thanks, Patti. Again, it was so great to talk to you.
Thank you.
Talk soon.
Okay.
Bye.
Have a great day.